Hello, everyone, and welcome back to the Veterinary Business Podcast, where modern veterinary leadership meets real world strategy. I'm your host, Dan Adisha, and I'm glad you're here. In today's landscape, conversations about practice value, private equity, and selling a clinic are happening more than ever. But for many practice owners, these topics still feel complex, overwhelming, or even a little bit intimidating. Questions like, what is my practice actually worth? How do buyers evaluate clinics? And how do I make smart decisions without leaving money or control on the table? That's where today's conversation comes in, because maximizing value isn't just about the day you sell. It's about the decisions you make years before. Joining us is Carson Taylor, co-founder of Value. Carson isn't just a consultant. He brings a heavy-hitting financial background, having spent nearly a decade in healthcare investment banking at RBC Capital Markets. He has sat on the buyer side of the table, and now he uses that data to help independent owners understand their true worth. Carson, welcome to the Veterinary Business Podcast. We are excited to have you with us.
Yeah, it's great to be here, and thanks for having me.
Before we dive in, a quick resource for our listeners. If your practice is growing or trying to grow, but your marketing feels unclear, inconsistent, or overly time-consuming, we are offering a complimentary marketing strategy meeting with Lila, a veterinary marketing strategist who's helped hundreds of clinics improve visibility, attract the right clients, and grow with confidence. In this free session, you'll receive a clear review of your current online presence and a 6-month growth roadmap tailored to your practice, so you know exactly where to focus your time and energy next. You can book your free session at www.veterinarybusinessinstitute.com/MSM. Now, before we get into the heavy-hitting math of valuations, I want to give our listeners a sense of who you are. I was digging into your background a bit, and so that before Vet Value, you were the CFO for a community startup called Rent Sons. That feels like a massive pivot from investment banking. How did moving from Wall Street to a community-focused startup shape how you view small businesses, and owners today?
Yeah, that's a great question. It was maybe less of a strategic move and more of an opportunistic move. I knew I wanted to leave investment banking. I was in the very early stages of getting Vet Value set up, and I had a long-time contact approach me. He was the owner of this business, and we started talking about it, and he had built a successful business in one region in Rhode Island, and he was trying to figure out how he might expand that. And so the conversation just kind of continued. The title, was not that meaningful, right? I was a kind of CEO advisor, but I still work with that company today. And for me, working with small business owners and small business is infinitely more rewarding, not necessarily financially, but emotionally, than sort of working with the large companies that I did at RBC. It just, these are folks that really need your advice, and your advice can be very impactful. So it's really been a lot of fun.
Okay, that's great, because, that's who our listeners really are. For the majority of the bit. And let's dive right into the current state of the market. How has private equity changed the veterinary practice landscape, and what should owners know about how these firms evaluate practices before making an offer?
Yeah, that's a great question. I mean, at a really high level, private equity has changed really every industry. To set the backdrop, there's a tax subsidy for private equity and other investment companies called carried interest. Carried interest allows private equity managers to pay capital gains tax rates on the performance fees they earn when they exit their investments. This is a tremendous benefit and a great way to stack up wealth relative to paying an ordinary income tax on those substantial gains. The overall result, in my opinion, is that there are more private equity professionals and funds stocked with hardworking, smart, ambitious people than there would be if there was no carried interest. The goal or job of private equity managers, as they see it, is to be excellent business owners and investors. And they found investments in nearly every corner of the economy in nearly every country. And in the process, they've professionalized business ownership. In veterinary medicine, private equity interest really accelerated in 2014. It was at this time that the company NVA, National Veterinary Associates, owned by Summit Partners, was being shopped to the private equity world. Summit wanted to sell, and they were looking for another private equity buyer. Employed at RBC at the time, I went to a management meeting in LA with a potential buyer of NVA. We were there because RBC was a party that could underwrite a financing for the fund's acquisition. At that meeting, Greg Hartman told us that NVA's same-store growth had never dipped below 0% during the recession of 2009 to 2011. Almost no service industry anywhere in the U.S. had such a track record. Seeing this, as many private equity professional suitors did, quickly spread the word about how good a business veterinary medicine was. And the next several years, continuing through today, we've seen a lot of investment from private equity into the industry. As far as how the investment has changed the industry, it's kind of the story of the good, the bad, and the ugly. The good is that DVM practice owners who have built high-quality veterinary services businesses can now sell these businesses to a private equity-backed corporate for much higher valuations than they ever could in previous decades. In that respect, it's like never been a better time to be a DVM owner of a high-quality veterinary services business. Bad is that many of those owners have already sold their life's work into bad deals because they didn't take the time to properly prepare and surround themselves with quality experts working for them exclusively. And the ugly is some of the strife that you see in the industry today. The COVID boom in demand has subsided, but inflation has not. So the easy money for business owners is seemingly gone. The reality facing all private equity-backed veterinary service corporates and anyone who owns a veterinary practice is that it's no cakewalk to own a business where the key assets walk out of the door each night. It's not an easy thing to do well, whether you're a professional investor or a small business owner. Mistakes have been made, and there are a lot of clinicians out there who are burnt out and a lot of formerly great practices that have been brought low by poor corporate ownership. With respect to how private equity-backed corporates size up acquisitions, I think the key thing to recognize is that private equity firms are targeting a specific minimum investment return and a finite holding period on their equity investments. If the consolidator strategy is mainly one of growth through acquisition, the returns achieved will be higher if the company is able to buy the profit from those acquisitions low and sell it high. Therefore, when coming up with a potential offer to buy a practice, the private equity-backed corporate is almost always incentivized to look for a way to buy low or pay less if they can. For each practice to be acquired, the corporate will use an equity returns framework to determine what they could pay for it and work down from there to see if they can acquire it for less than that. Corollary would be that the only person that knows what that practice is worth to a buyer is the buyer itself. A selling DVM may get someone who is not a buyer to value the practice, but this valuation cannot know for sure how a specific corporate buyer or independent buyer may value the practice under specific conditions. All this should suggest that the way you sell your practice, or what I call the process, is very important when dealing with private equity-backed corporate buyers.
Now, you mentioned corporate buyers or else independent buyers as well. So with so many platforms really competing now, do you see a difference in that quality of buyers, or are they all running the same playbook?
No, the playbook is really different and varies greatly. When I say independent buyers, I tend to mean doctors, right? Doctors out there buying practices. And then when I say corporate, almost all of them are backed by private equity money, but corporates are buyers that, grow by buying practices and adding them to the company. But the way that these acquisitions are done, for instance, the type of consideration used, for instance, the specifics of the contracts, employment of contracts is very different. They're very different models. I mean, fundamentally, what these private equity owners are trying to solve for is, how do we purchase practices or purchase assets where the people are really important, right? The most important part of what we're buying, and keep those people incentivized as the ownership transitions. And there have just been a lot of different approaches taken to that very question, because it's a very difficult thing to do.
Mhm. Whereas on the other side, with regards to the doctors, what are we looking at there?
Well, doctors, when a doctor buys a practice, it's usually a practice that does not come with a doctor. Um,
Mm.
Taking a step back, if you think about a veterinary practice, the as I said before, the people in that practice are really the key assets, right? The team, they're using equipment, they're using technology, and they're delivering veterinary medicine. Um, Corporates tend to pay higher prices. They have better access to capital. They have sort of a playbook of what they do, how they integrate their acquisitions. And so when a practice gets to beyond a certain size, let's say that is 3 full-time doctors, and that might include the owner if they practice there. When a practice gets to a certain size, it's almost always a corporate buyer that will be able to pay more for it. So a lot of the independent transactions where I'm a doctor, I'm an associate doctor, and I want to get into practice ownership, those tend to be practices that have either no doctors that will survive the transaction or maybe one, much smaller practices. So, independent owners and DVMs, they tend to use their own playbook as well, acquired from experience. But the goal is the same. It's, if I'm actually buying this practice and it's coming with a team, how can I make sure that keep that team productive or make them more productive and keep them happy? Both corporates and independents are really striving for that in their acquisitions.
Got it. And let's look at some of the key factors that determine a veterinary practice's value. What are they, and how can owners accurately assess their practice before considering a sale?
Yeah, good question. It might help to be crystal clear on what we're valuing. When I talk about a veterinary practice, I'm referring only to the operating business. The building, real estate, even the truck that houses the business is a different asset. Though it might house a veterinary practice, a building with time can house another business. So it is value that exists outside of the business that rents it. Generally, the operating business, as I said before, consists of people using technology and medical equipment to administer veterinary services. The value of the actual physical assets, those assets that might appear on the balance sheet as property, plant, and equipment, can be far, far below what someone would pay for the practice. The value of the operating business then is mostly correlated to the quality of the team delivering the service. High quality, effective teams are always more valuable, but placing a value on a team of people is pretty tricky. So you look for proxies. One major proxy which applies to veterinary practice is the sustainable revenue growth rate. Practice that can demonstrate sustainable growth above the industry or local markets growth will always be valued with a higher valuation per unit of sustainable profit or revenue than one that cannot. Another proxy for team quality is the size of the clinical team. Practices with more DVMs and techs are more valuable because they indicate effectiveness in the team and management, and they're also a lower risk acquisition for the buyer. There are other proxies for team effectiveness, but these two factors, the sustainable growth rate and the size of the clinical team, are by far the most important factors in determining the valuation multiple. Now, an owner assessing or trying to understand the value of their equity in their practice should, in my opinion, be a periodic exercise. Over 10 to 20 years, you as an owner can do a lot of things to build equity value in your business. For instance, hiring, training, and retaining productive and happy staff, including DVMs. A periodic, say once a year, third-party valuation can estimate the equity value created by high quality management over a number of years. You can kind of track your progress. What a third party valuation struggles to do is properly estimate what someone with their own assumptions, strategic goals, and growth plans may pay for a practice when competing against others to acquire it. There's also additional mud in the water of practice valuations since the parties that offer them have different experiences and incentives. Brokers have sold practices, so their valuations to this end might be more attuned to the current market and user friendly than, say, a CPA who does not sell practices. But what the broker really wants is to sell your practice. So the valuation can be used as a means to winning the business or setting your expectations as to the outcome. You also get a garbage in, garbage out issue with practice valuation. When we take on a client who wants to sell, we spend weeks building a detailed view of what is driving value in the practice. It's only after we built this view that we can discuss in any meaningful terms what kind of valuation we would expect in a sale. And even then, we always point out it's just an informed opinion. Our goal as financial intermediaries is not to set the valuation, but to set the circumstances that surface the best valuation available from the buyers in the market. So I can boil it down. That was a lot there, but let me just boil it down. I would, if you're a business owner, consider getting a regular valuation to estimate the impact of your efforts to build equity value in your business. That's number one. Number two, to get the most out of a practice valuation exercise as a prelude to a practice sale, make sure you understand the incentives and experience at play for anyone you're hiring to value your practice. Finally, for valuation in a sale context, the sale process you use to uncover the different valuations that corporate or individual buyers might have for your practice is far more important than any informed opinion from someone who is not going to be writing a check. I've got an example that can put some of this in stark relief as well. We had a practice sale client who came to us with 4 consolidator offers in hand. 2 of the offers were about twice as high as the lowest, and the 4th was 4 times as high as the lowest. So 4-to-1 range. Or if you want some hypothetical numbers, say the lowest was 1 million to buy the practice, and the highest was 4 million. The client hired us to run our sale process. At the end of that process, the client received some new offers, the highest of which now called for 2 times more in cash at close than what the previous highest offer had called for in total. So let's say 8 million in cash at close versus 4 million being the highest previous offer. Factoring in consideration to be paid after close in certain circumstances, for instance, an earnout or corporate equity, that all-in sale consideration was actually 10 times more than what the original highest offer had been. So that would be 40 million versus that 4 million initial offer. There are 2 reasonable conclusions from a story like this. One, we talked about there's no right answer for what a practice is worth to an individual buyer. You really have to go through the steps to figure that out. And the process used to surface the offer makes a huge difference.
Wow. And I would like to know, what is the timeline for this? Like, when they got the 1 mil offer, 4 mil offer, and then, of course, once Vet Valley was doing the valuation and then getting that final 8 million offer.
Yeah, well, this was a pretty quick sale process. This owner was ready and pretty sophisticated. So he was getting those initial offers in the summer, and we had closed that practice sale by the end of the year. But
Wow.
that, as I said, was sort of an extreme example. That owner was ready, and we were able to move very quickly. A lot of the timing from, okay, I'm ready to sell my practice to, okay, I've closed the deal to sell my practice. A lot of that is really driven by how much time the owner can focus on it, or what the owner's objectives are in a sale, or whether the practice is not quite ready and there are things that can be done in a short period of time to make that practice more attractive. So the timing really varies a lot, and we tend to kind of follow the owner's lead.
Okay. Um, so let's talk about, where things could go wrong, because that's often where most of the learning happens. So,
Yeah.
Carson, what are some of the most common mistakes you see practice owners make when preparing to sell, and how can they avoid leaving money on the table?
Yeah. I mean, I see a lot of mistakes. And it might be just useful to contrast or paint a picture of what professional investors do when they sell their business. By
Okay.
professional investors, I'm referring to the private equity firms I used to work with at RBC. Here's an interesting story. When I worked at RBC, I remember getting a call from a private equity firm to discuss the valuation of a healthcare services company that they owned. That's a pretty routine call in investment banking. But what made this notable is that the private equity firm had just closed the purchase of that portfolio company. They're 3 to 5 years from selling it, and they're already strategizing about how to sell that company as gracefully as possible. DVM practice owners generally don't think like this. Most will build their practice best they can for as long as they can, and then they sell it to someone who offers to buy it for what they assume is the value of the practice. Private equity owners, by contrast, are always thinking about the eventual sale. They're continuously building relationships with lawyers, investment bankers, and managers that can help them. They're looking at how comparable companies or similar companies are valued and determining future investments on the basis of what they believe will build the most equity value in their business. Now, not all of this is going to be something a practice owner has the capability to do, but each can start to think about their exit long before they plan to exit by endeavoring to build relationships with advisors and other experts that can help, and evaluating investments that can make their business grow in a sustainable way. I mean, if I could pick
Mhm.
sort of the three most costly mistakes DVM
Yeah.
sellers make when they approach a practice sale, the first we kind of already talked about, but it's assuming that there is one valuation for the business.
Yeah.
It's definitely not the case, right? Every party that values it, your business will have a different answer. If you want to secure the best value in the context of selling your practice, you're going to need to uncover as many valuation opinions as you can. In this endeavor,
Mhm.
it's all about the sale process. That's of paramount importance. Secondly, I think DVM sellers, a lot of times they don't fully understand the incentives of the corporate buyers. Like the practice buyers' incentives are not aligned with the sellers, right? Corporates have a lot of people in the field calling on owners, building relationships. As nice as these individuals may be, every dollar they can avoid paying you for your practice is a dollar that their company earns. If you sell with the mindset that the buyer will walk you through it or take care of you, that the offer they've shown you must be a fair value, without hiring your own experts on both the business and legal side, you will leave substantial money on the table 100%. And I see this happen regularly. Finally, I think DVM sellers tend to misunderstand the role of legal counsel in a practice sale. Legal counsel is there to protect your downside in the mechanics of selling your business. There are a lot of things can go wrong if you don't have a lawyer inspecting an asset purchase agreement. but you shouldn't hire your legal counsel to market your business or perform financial due diligence. Both of these things you have to do to sort of effectively describe the business that you're going to be selling. You should also not rely on your legal counsel to take the lead on business negotiations. I found that business people like to talk to other business people and negotiate with other business people, not lawyers. If you bring a lawyer to the table to talk about the business terms of your deal, the other side will bring their lawyer, and you'll be paying a much higher legal bill for a worse outcome. So I would say those are probably the three most costly mistakes.
And for our practice owners listening in who aren't planning to sell immediately, what are the strategies that they can take to implement now to increase the value and attractiveness of their practice to potential buyers 3 or 5 years down the line?
Yeah. I mean, there's a lot you can do depending on the time frame, but the goal is really always the same. Continuously build your business in a sustainable way. Like, let's say start with a really long time frame, 10 years. You just got into practice ownership. Today, if I'm in that position, I just opened my practice. Okay, I've got a few techs working with me, a few CSRs, things are starting to move along. But my business today has almost no equity value. That's because if someone else were to buy my business and I were to leave, that buyer would need to replace my efforts, which generate the vast majority of the practice's revenue and profit. Now, let's say I live in a market that seems to have more demand than I can service. It's a good market and people want more veterinary services. I may be tempted to try to expand by hiring another DVM.
Mm-hmm.
I would first make sure that I can make my practice hum with just me. Spend time thinking about how all of your clinical employees, ways to make them more productive and happier. All licensed or unlicensed techs and you, the doctor, should be working at the top of their licenses. Certain administrative activities should be delegated and effectively managed. Once you have everything well run, then consider hiring a DVM. Once the DVM is in place, again, focus on productivity and staff happiness with your larger team. Repeat. You can add services or expand your plant, but those avenues for sustainable growth will not really be fully unlocked if you can't figure out how to build and maintain a productive and happy team. That's key in this industry. One great resource for practice owners who are, years away from a practice sale, I think, are study groups. In this format, simply, you're joined with other business owner peers in different markets, and you're given opportunities to collaborate on best business practice, underpinned by, sharing specific data under NDA on your practice. In effect, you can learn how to run a better business from your peers while having a support group. It's my opinion that really every practice owner should join a study group like this if they have at least a 5-year time frame in business ownership. You really don't have to do business ownership on an island. Now, shorter term, within 1 to 2 years of a practice sale, the playbook is more limited, but the goal is the same. Grow and build your business in a sustainable way. When we take on new clients, we always spend time trying to understand whether the client has any short-term levers that can generate value in a sustainable way. Often we can present a menu of options organized by sort of degree of difficulty and time to achieve. But again, that menu is going to be a lot narrower than if you're 10 years away, if you're 20 years away.
Can you, give us some of those perhaps short-term levers, a bit more insight into that?
Well, we do try to focus on doctor and staff productivity, right? I mean, there are metrics, right? Like the average doctor, their productivity is going to be their productivity measured as production. You can get industry benchmarks, right? So if you have a client that has some doctors that are sort of lagging those benchmarks, it begs the question of why. And a lot of times it's because the practice is not really set up to get sort of the most out of their techs or support staff. Or in other cases, it can be the doctors are spending a lot of time doing administrative work that that could otherwise be facilitated or automated, right? So these are the kinds of levers we'll look at. Now, increasing the productivity of your doctor is something you can do in 1 to 2 years. But if you have 10 years to think about it and work on it, you can do a much more thorough job, right? So it kind of illustrates sort of how important the time frame is. I mean, another big area obviously is pricing. Um,
Mm-hmm.
when a corporate, they're professional owners of practices, right? So they spend a lot of time thinking about how they price their services. I think they spend a lot more time than your average small business owner. And so we help kind of practice owners to review and take a look at their pricing the key is in a sustainable way, right? You don't want to just be raising your prices and losing clients, but there's smart ways to think about how your services are priced and how there might be room in some cases to increase the price on certain services, and things like that can in the short term have a good impact on valuation.
Got it. Now let's walk through the finish line. Once an owner decides to sell, what does the ideal step by step process really look like? And how can a consulting expert like yourself help ensure the practice owner, gets the best outcome?
Yeah. Well, the ideal step by step process is to carefully prepare for and run a structured auction process with all the potential buyers that are most likely to find ownership of your practice strategic. At the end of this, you want multiple firm offers from different parties to buy in hand. And you want to know that those potential parties have received really substantially the same high quality information on your business and the same access to management. It's really as simple as that. But doing that is far from simple. Um, think back to that private equity firm, right? They were vetting business sale professionals years before they were going to sell. That's why they called us in there. In part, they were vetting, okay, do we want to sort of keep working with this bank on this portfolio company? Do they know what they're talking about? So really the first step for a DVM owner, assuming that you've never run sort of a structured auction process for a business sale, which
Yeah.
almost none have. So the first step is going to be to carefully vet potential business advisors. A broker is like a type of business advisor. Um, I use the term broker, business advisor, financial intermediary sort of interchangeably, though there are some subtle differences. So you want to start vetting potential business advisors and legal advisors. That's really the first step. Now, in both camps, there are many options out there, but the quality, experience, and pricing and service level is going to vary greatly. So though I may be biased, I think the single most important decision the selling practice owner can make is who they hire to represent them. Being systematic is really the only way to do this right. For instance, maybe create a list of 5 to 10 brokers and 5 to 10 lawyers. Come up with 10 questions for the brokers, 10 questions for the lawyers. Ask each broker each question. Ask each lawyer each question. Okay, record their answers. Remove the parties that you think are the worst fit for you. Come up with a second round of questions to ask all that remain. Narrow the field again. Then ask for and call references. Take as much time as you need to systematically decide who will be the best advisors for you. I think if you hire the right broker and lawyer, you will be successful in your practice sale. If you don't hire the right broker and lawyer, you're likely going to have some problems. And I think the issue that causes people not to hire the right broker and lawyer is that they don't spend enough time really thinking about that step and vetting all the professionals that are out there.
I was going to ask, this vetting process, Well, what's the ideal way? What are we looking at? How are we, really wetting them according to you?
Well, you're asking questions that are relevant. So if and we do some of this, right? We want to know in our business all of the attorneys who specialize in veterinary practice sales. So we'll come up with sort of a standard list of questions that we ask each one of them. And these are things like, you know, how many deals have you represented on in the last year? How many of those deals were a DVM to DVM sale? How many were you representing a practice owner that was selling to corporate? How many of those deals had a JV equity component to them? Um, and then obviously you can ask, how do you charge for your services? How do you participate in or facilitate the due diligence process? You just want to come up with questions that kind of help to understand what they provide, and that can sort of be compared from one to the other.
Hmm.
There's maybe a bit to that, but I have done some writing in certain formats on some of the specifics of this. But I think if you start talking to if you don't have a great idea of where to start, start somewhere, right? Okay, I'm going to start calling lawyers. Here are, I think, 10 basic questions. Now, they might not be very sophisticated questions, but they're 10 questions I can ask all of them. So I'm going to ask all these 10 questions. And then on the basis of the answers, you can kind of trust your intuition as to, okay, I liked this answer, but I didn't really like that answer as much, right? And you can kind of do that kind of an exercise, I think, to compare and really find somebody who's going to be a good fit for what you're trying to achieve. But it's all sort of about being systematic and starting broad, and then narrowing the field down based on the information that you get. And you're going to learn something as a practice owner from every one of those conversations that likely will help you ask better questions in the next round, right?
Absolutely. So Carson, we have reached the end of our session here. Before we wrap things out, I would like to get one key takeaway, the golden nugget for our, potential sellers out there. What is the one key takeaway if they could only take away one from our conversation here?
I would say if you're going to sell your practice and you're going to entertain interest from a private equity backed corporate, do not go through that. Do not entertain that interest without spending a lot of time thinking about the team of experts that's going to represent you. In other words, said more succinctly, when you sell your practice, don't go it alone, unrepresented by a business advisor / broker.
Right. So Carson, thank you so much for, this grounded conversation.
Yeah. Thank you so much for having me. And it was a great discussion.
Absolutely. And if our listeners want to reach out to you or use Vet Value to see where they stand, where should they go?
They can start with our website, www.vetvalue.pet, or they can send me an email. I'm Carson@vetvalue.pet. I'd love to hear from any and all of you.
And to our listeners, thank you for spending the time with us. Whether you're actively selling or just thinking about the long-term future, we hope this gives you clarity. If Carson's insight resonated with you, we encourage you to explore the work he and the team at VetValue are doing. And before we wrap up, a quick reminder, you can book a complimentary marketing strategy meeting with Lila, where you will receive a personalized review of your clinic's online presence and a 6-month growth roadmap tailored just for your goals. Visit www.veterinarybusinessinstitute.com/MSM to schedule your free session. With that being said, from all of us here at Veterinary Business Podcast, thank you for investing in your business, your future, and the legacy, the practice you worked so hard to build. We'll see you next time.